Welcome in, everyone, to this webinar on the investment optimizer. We're going to learn how to add a layer of profitability to the real estate investing that you are already doing. My name is Blake Brogan. I'm here with Rod Zabriskie. We are with Money Insights, a firm that is dedicated to helping high income earners really optimize the investing that we're doing. And what you're going to learn about here, the investment optimizer is really one of the core strategies that we teach. And so really the main focus of the strategy is exactly what it says right here. We want to enhance the profitability of the real estate investing that you are already doing. So the purpose of this is not going to teach you how to invest in real estate in a different way than you're already doing. Instead, you're plugging the investment optimizer into the real estate investing that you're already doing in order to create more wealth than you were doing before. So how do we do that? Well, a couple ways is we're going to create tax-free growth. We're going to preserve liquidity. We're going to protect your capital. So if you think about the way that most real estate investors, this could be you, is investing, we typically just build money up in a bank account. It's in a place that's just sitting there waiting to be deployed into the real estate investing. We go deploy those dollars into those investments. And then as the cash flow gets kicked off, it goes right back into that savings account. The investment optimizer is just going to be able to do more with your dollars while it's on the sideline, waiting for the next deal. And then really the fun part about this is we're going to be able to create value in multiple places with the exact same dollars. Now that may sound crazy. We're going to get into all the details of how we do this. And we're going to jump on the numbers really quickly. Now, some of you may have heard of concepts very similar to this. Oftentimes it's called infinite banking, cash flow banking. It goes by a lot of different names. The investment optimizer falls down that category. However, it's really hyper-focused on how to utilize this strategy primarily with the investing that you're doing. So as we get into this webinar, we'll kind of share some of the differences, but this investment optimizer is really going to allow you to create more wealth than you would have been able to create had you been using the typical ways that people go and flow their money through the real estate investing that they're already doing. So Rod's going to jump in onto some of the numbers of how we're able to do that.
Absolutely. Yes. And really our whole goal today is to help you see how this thing works. But from the get-go, we wanted to give you a good flavor for really what it's going to do for you. So as we get into more of the details, you at least have a vision for what we're doing, like how it's going to benefit you in your world. So what we're going to do is just do a side-by-side comparison. So Blake just talked about how we're using this to improve what you're doing if you're just using a regular savings account or money market account for your investing. And so we're just going to put it side by side. Investment optimizer right next to just a regular savings account. And so for this, just for the comparison, we're going to say, hey, what if someone's setting aside $100,000 a year for 5 years to capitalize their opportunity fund? Okay. And initially they're going to use those funds to go and invest in a syndication. Okay. That syndication starts to kick off some cash flow. They capture that cash flow back in their system and then they build up. And then subsequently, we're going to go back out and invest in multifamily properties. Now, this obviously works regardless of where you invest. We work with a lot of different people who invest in different ways with their business or with real estate, obviously, hard money lending, all kinds of different things. In this example, obviously, we're focusing on real estate. So we invest in that real estate, we start kicking off some cash flow, and we just flow that all back into the system. In other words, basically what a lot of you are doing now. You take that rental income and you put it in the savings account or whatever, you build the account back up and you go back out and you invest again. And you just create that cycle, rinse and repeat, right? So with the investing, specifically what we're going to do is we're going to say for these properties we're going to purchase, we're going to go get an 80% loan from a traditional lender. And then we're going to have 20% that we're paying down. And that 20% down is on the left-hand side, you'll see us using the investment optimizer for that 20%. On the right-hand side, you'll see us using the savings account for that 20%. Again, create that more cash flow, churn that all back into the process, go back out, invest again. And just for our assumptions on this, we're using a 10% cash flow coming from the investment. This is what we're flowing back into the system. That's our net cash flow. And then we're also going to assume a 5% appreciation on the property. So before I get here, often when I talk about the numbers and what our assumptions are, I'll have some people say, well, I wouldn't do a deal for less than 10%, right? I have to get more than that. Or I'll have other people say, man, I sure wish I could always capture 10%. The point isn't as much to say, hey, this is what you are or should be doing, as much as just to say, hey, if side by side we're using the exact same assumptions on both the investment optimizer and the savings account, then we can see, relatively speaking, how it performs. And so that's the whole point of the numbers. Same thing on the appreciation. It applies across both sides equally. Okay, so let's just look at the numbers. So as you can see here, left-hand side investment optimizer, right-hand side savings account. And we start putting that money in. That first year, we put the $100,000 in, and we get it to work right away. We're going to go invest in the syndication. Now, I can hear you right now. You're thinking, Rod, I'm looking at this, and I'm seeing on the left-hand side, 74,000 going into the syndication through the investment optimizer, 100,000 going in on the savings account side. Well, wasn't this supposed to be better? And we'll get into more details on exactly the vehicle and the other things like that here in a minute. But the fact is, there are some costs for what we set up on the left-hand side. It's just part of the program. It's kind of what comes with it. But what you'll see is that in the long run, we're just much better off for it, right? We end up creating $2 million worth of a difference over 20 years. And that's something we couldn't create if we didn't take on those costs up front. So we absolutely acknowledge it. It creates costs up front, and therefore an opportunity cost, because I have less money to invest. But as you can see over time, we not only overcome that, but we overcome it and then more to just create so much more value over the 20 years than we otherwise would have if we just continued using the savings account. Let's see how that worked out, right? And just let me be really clear about this. We totally understand that the most of the value that we're getting out of this is because we're investing in real estate. We're doing really cool things with real estate. So we take that original 500,000, and either way, like even on the right-hand side, we turn that into 20 million bucks, right, over 20 years. And so again, all the principles that you know and love and use today. But if we could do the same thing, but by flowing the money a little bit differently, instead create 22 million of total value in the future, well, who wouldn't want that, right? And so that's what we're going to do, is we're going to break down the pieces and help you see how it works as we flow this money through the same deals as you are today. How can we produce more? How can we do more with it? And Blake gave you kind of a quick feel for it in that first slide. And we're going to get into more detail. We're just going to break it down and show you how it works. We'll talk through the vehicle. We'll get into the process, the flow of the money, a lot of different details. And so hopefully you'll see in the long run how we get to that point. Okay, so the first thing is what we call the opportunity fund, right? What's the problem? Well, the problem is you have dry powder, right? You're building that up, right? Whether it's setting money aside from your regular working income, or whether it's capturing the money that you have flowing off of deals and setting that aside and building it up. What are you going to do with that, right? You need it in a place where you have liquidity. You need access to it when you're ready for it. And number two, where it's safe. You don't have to worry about losing value while it's sitting there. Okay. Well, what are our options for this, right? What kind of opportunities can we take advantage of? Well, number one, savings account, right? We just hit on that. That's the most common thing that we find. For people who are, a little bit fed up with that, we'll see people go out and get online accounts. Oh, okay, now I can get, 0.75% instead of 0.1% or something like that, right? Or they'll go out and get a money market. Maybe they can create a little bit more growth with that. Okay. Well, that's the extent of the creativity of kind of what most of us are aware of or have access to. But in this case, we're going to show the investment optimizer as another option. Well, you notice I didn't include in this list stock market, like a brokerage account, right? And it's not that we don't ever see or haven't seen people who use that as their opportunity fund, where they're flowing the money in and out of their deals. But if I go back up to the dry powder and kind of that safety factor, most of the people we work with, they just don't want to be worrying about putting it in the stock market. But the people who we have met up that do, why are they doing it? It's because they're just not really getting a return in it while it's in there, right? That they don't want it just sitting in the savings account. They want it to be working for them while they're between deals. And so, what other options do they have? That's kind of what they go to. But we're going to show you today why the investment optimizer is the best option for this. So we'll jump into it by getting into the vehicle and show you how that works.
So we'll get into the strategy after this, but what is the vehicle that we're using? We are using what we refer to as max overfunded dividend paying whole life insurance. Now, one, that's a mouthful to say, but second off, when you see that that phrase there, one of the first things that pops to people's mind is life insurance, right? So we're actually using life insurance, something that many people have been told to stay away from as a wealth building tool, but we're using life insurance in a very specific way. Again, the investment optimizer is not about insurance in maybe the way that you would typically think, where the focus is on protection, but instead the focus is really on the value that we can build up for the living benefits or for the use of it. Again, this is going to be an alternative opportunity fund that we're going to use to replace those savings or money market accounts that Rod, you talked about. So what are the benefits when we structure life insurance policies in this special way? What can we get? Well, the first thing that we can expect is net after all fees and everything's been taken out. We can expect over the long term to earn right about a 5% return. Now, that's a 5% return in today's very low interest rate environments. And we realize that 5% isn't going to blow you away, right? Hopefully you're able to earn a lot more than that in your real estate. But again, when we get into the strategy, you're going to see how this 5% can just be in addition to what you're doing in the real estate. Now, the second thing that we're able to do is have this be a completely tax-free growth and tax-free use of the money. So especially for high income earners, right, that 5% tax-free could be equivalent to, 7, 8, maybe even 9% taxable. Now, the other two primary benefits that we have to have are the safety and the predictability. Again, when it comes to where we're storing that dry powder in between our deals, right? We need to have that safety, security, and that predictable growth that we know those funds are going to be there when time to invest into the real estate deals that you're going to do. We need to have that there. Now, of course, this money is liquid, so we have to have access to it. We can utilize it just like we would in a savings account. We just get those additional benefits. And then the fifth benefit is this idea that we do have a death benefit. So we're talking about life insurance, again, in a totally different way than most people think of utilizing insurance. But at the end of the day, there is going to be a very significant death benefit that's associated with these policies that you really don't have to pay for in any other way. Now, the sixth part is really what I find the most fun is we're able to use what's called a loan provision. So we're able to access other people's money and using these policies as collateral. And that's what allows us to earn the multiple values or multiple rates of return at the exact same time. Again, that can sound too good to be true. Let me kind of break down for you exactly how that happens. So the vehicle we're using are these life insurance policies, but here's the strategy behind it. So you're going to take dollars and you're going to deploy them into this opportunity fund or this max overfunded dividend paying whole life insurance policy. So the dollars that you're hoping to invest, as opposed to going into bank accounts, they're going to go into this opportunity fund. Now, we mentioned that it can earn right about a 5% rate of return. Well, how do we do that? Well, there's really two primary things that's going on here. The first is that there's a guaranteed interest associated with these policies. This is very important because what it means is that it's not volatile. Now, this guaranteed interest, depending on the type of policy, can range anywhere from 2 to 3.5, maybe 3 3/4. Most of the companies now, they're offering right about a 3% guarantee. So we have that guarantee. And on top of that, the type of companies that issue the type of life insurance policies that we're talking about here offer dividends. So dividends aren't guaranteed, but the type of companies that issue these policies are actually run for the profitability of policy holders. So they are not guaranteed. However, the companies that we do business with have often been paying them for 150, maybe even 170 years in a row. So they're very safe and secure companies and very dependable. Okay, now the fun part. So we have this money, it's building up, it's growing, right? It's earning us a rate of return. Well, when it comes time to invest, as opposed to liquidating our account, taking money out of our bucket like we would a savings or a money market account, because we have this opportunity fund, we get access to this much bigger bucket of money. Okay, now this much bigger bucket is the general fund of the insurance companies that issue these type of policies. So because we have this opportunity fund, we don't have to take the money out. We can get access to their money. Now, this bigger bucket of money, the way that we typically access the funds is through a loan. Okay, so we're taking a loan from the insurance company's general pool of assets. We take that loan and we just turn and deploy that into the real estate that we were already going to do anyways, right? So now we got this real estate investment. It's kicking off cash flow. We just take that cash flow and we use it to repay the loan that we took from the insurance company. So as opposed to flowing money in and out of our savings account, we're flowing money in and out of this loan into the investment. As it kicks off cash flow, it goes right back into paying off that loan. And so this cycle of money that you're going to use for your real estate investing is just flowing out of that much bigger bucket of money. Now, here's the very unique part. Is this line's going to come down here. Okay. And what this really represents is that these are two very separate buckets of money. So what happens is as that money's flowing out of the loan into the cash flowing investment back into the bigger bucket, your entire bucket of money in the opportunity fund was continuing to earn that compounding interest, that guaranteed interest plus the dividends, because we never removed the fund. So this is very literally how we're able to create multiple rates of return. We have the entire bucket of money. Every dollar into our opportunity fund continues to grow and compound, earn interest and dividends. And we have access to this other bucket of money using loans to go do the investing that we were already going to do anyway. So very real, we're able to create multiple rates of return with the exact same dollar.
Perfect. And really what we're doing is on the back of leverage, right? Which most real estate investors that we meet use leverage on a routine basis in everything that they're doing. So let's just hit on the points of how we're using leverage. So the first one is we're creating that tax-free growth inside of our account. It stays there. It continues to do that, like Blake just mentioned. Number two, because we're accessing the money in the way that we do, we are literally creating value in multiple places at the same time. But the third thing that we haven't really expanded on that I'll talk through here for a minute is that we create an arbitrage. In other words, if our money stays in the account and continues to grow while we're using and flowing the money through the loan side, then that means that the money on our policy, it just grows on a compound basis, unimpeded, right? But the interest that we're paying on the loan side, it's simple interest. Okay. So I'm going to show you here how this works, because really the key is we know what compound interest is, right? And the sooner we can get going, the better, et cetera, right? Well, in this case, we have the compound, but against simple, but not just simple on a flat line, but simple on a decreasing balance. In other words, as I'm flowing those returns back into the system and I'm dumping them back in, essentially paying down the loan. And so I'm paying less and less interest each year. Okay. Now, I think most people kind of get the idea between compound and simple, but I think it really helps if we put some numbers to it. So let me really quickly just walk you through an example. In this example, I'm taking a $100,000 loan against my policy, right, against that cash value of the policy, and I'm paying 5% interest. And in this example, I'm just going to amortize the payback over 20 years. Okay, so I'm paying $8,000 a year towards this loan, pay it down. At the end of the 20 years, I will have paid a total of about $60,485 in interest. Okay. Simultaneously, I have the $100 that's in my account that is continuing to grow and compound. Even at the same 5% rate, when I play that all out, by the end, I will have earned about $165,000 in interest. Okay, so let's put those side by side. I earned 165. I paid 60. In that example, off of a relatively small number, even just that 100,000, I made $105,000 difference in what I was earning versus what I was paying over that 20 years. So that just helps illustrate the power of this arbitrage, the power of creating value in multiple places at the same time, and how it all kind of works. It may have sounded like magic in the beginning. But I think really it's just a matter of understanding the numbers and the math behind it that just makes it all work for us. Okay. All right. So hopefully you're getting a good feel for things, because we're going to throw an extra little twist. And this is an extra nugget, especially if there are people who are watching this who are already kind of familiar with some of the things we're talking about here. Well, there's another additional way that we can approach this to make it even better. Okay. And that is, if we are using loans, not just from the insurance company, but we actually substitute in a loan from a bank. In other words, I have my money in my policy, it acts as collateral, but instead of acting as collateral on a loan from the insurance company, it's now acting as collateral from a line of credit that I've set up with an outside bank. Okay. Well, why would I want to do that? Because I can get better interest. Right. In my example a minute ago, I talked about I was using a 5% interest rate, and you might have been thinking, man, 5% interest on a loan. Why would I do that? Well, you don't have to, right? We can go and get a loan from a bank where we can get a 3.5% interest rate. Okay. And so if now we go back and we play through the exact same scenario that we talked about right up front in the webinar, and I take that same $100,000 a year for 5 years that we were setting aside and then going out and investing, creating cash flow, flowing that money back in, cycling the money through and going back and doing more. Well, in this case, I'm going to do it with a better interest rate on the loan, right? While my cash flow continues to grow the same way. I always tell people, hey, check with the bank you already do business with. But if not, we have a list of banks that we can send you to get set up with. And the cool thing about this is it's a line of credit, right? I can switch it out. Like if interest rates changed and all of a sudden, hey, I want to go back and get loans through the insurance company now. Well, not a problem. I just make that switch. And so it's easy to go back and forth between the two, just depending on which one's better. So now let's get into those numbers. So our starting point is exactly the same, right? 100,000 a year for 5 years, setting those aside to go out and invest. You'll notice that the initial 74,000 versus 100,000 is the same as we had in the original one. But as we play that out and we play that forward, then you'll notice that we're able to do even more with the left-hand side as we get down the road to those future purchases. And ultimately we get to the point where we end up with a $3.1 million difference. So imagine, same strategy, same dollars, but by substituting that bank loan in, I made a 50% additional bonus on top of the cool benefit I was already creating anyway. And so hopefully that's a good nugget for everybody, because it's just a really powerful way to take a really already powerful strategy and just make it better.
So we've thrown a lot at you. Hopefully you found this educational. Just want to hit some of the key takeaways that you should have from this webinar. Again, Rod and I love real estate investing, and we're just hyper-focused on helping real estate investors just do what they're already doing better. So the investment optimizer at the end of the day, it's really just about math, and it's just about adding an additional layer of profitability onto the things that you are already going to invest in anyways. We're creating tax-free growth. We're putting our money in a place that's safe, and we can create some very predictable growth that we have access to, of course, at any time to go do the things that you're already going to do anyways. Now, we didn't mention this, but one of the additional benefits that just comes along with these policies, and this is very state dependent, but most states have incredible creditor protection. So especially if you're a high income earner, you got a lot of deals that you're doing, a lot of exposure. Having capital in a place that's completely protected from creditors can be an awesome benefit. And then we're not going to get into it too much here, but a lot of questions that happen is like, okay, Blake and Rod, I've built up this big account. I got all this cash value. I'm investing. Well, at some point, I kind of want to scale that down. We talk about retirement income. A lot of the people that we work with don't think of retirement maybe in the same way that most Americans do. But what's the end goal of this? Well, one of the awesome end goals is this is just an additional place that we can use to create completely tax-free retirement income sometime down the road. So it can be used as a way to supplement maybe the retirement income stream that you're planning to take during your later years from the real estate investing that you're already going to do. So we hope that you have found this educational. If you are like just about anybody who's exposed to this idea for the first time, you probably have a lot of questions. So feel free on this page below. You can go ahead and schedule a call. We try to make it very easy and very simple. We aren't very salesy guys. So what we like to do is just start with a 20 to 30 minute phone call. We call it a clarity call. The purpose of that is really just for both of us to get to know each other a little better. So we'll ask you some questions about the real estate investing that you're doing. You can ask us any questions about the strategy. But the purpose of that is just to answer some questions and see if this is going to be a strategy that's going to help you do the things that you're already planning and hoping to do better. Feel free to check out more about us at moneyinsights.net or schedule a call below.